These macroeconomic charts will blow your mind and hopefully at the same time provide a little bit of clarity into what is going on and where we are headed. So let's dive right in. First up, you always want to look at investor positioning. This is a casino. The market makers love to clear the board when everyone is crowded in one side. It's called a short squeeze, and you can make a lot of money by just fading the herd as they try to all leave out the same exit. So right now, aggregated US equity futures positions are the most short on record, according to Deutsche Bank. Look at where we are. Now, I'm not saying we're in a great environment at all. All I'm saying is there could be a dead cat bounce, there could be a relief rally, there could be a short squeeze. So get ready for a market bounce to clear all these positions out. Unfortunately, that's the reality of how markets work generally. Let's look at the underlying fundamentals of the economy, because these people are absolutely right if you just look at charts like this. Copper versus job openings. So it's very interesting to think about how correlated everything is. Red is the copper chart, white are job openings. So when copper's crashing, we're normally in a recession/depression period, job openings go down. And look at how closely copper and job openings have been correlated. Well, copper's crashing, the market's starting to worry about a recession, and so job openings are unfortunately about to collapse. That would not be good for the market at all or for the economy. At the same time, all this is happening, we have a significant acceleration in rents. Look at what is happening to rent. It's not a great situation. We have increasing inflation in a very soft economy. So hopefully the stagflationary period can resolve itself well. But look at this chart. Significant acceleration in rents. That is very painful for people right now. Inflation is the biggest tax. At the same time as inflation, rents, cost of living skyrocketing, you have central banks around the world in a panic to raise interest rates. This is the number of rate increases by amount among 55 central banks, month-on-month change in current policy rate, reaching almost an all-time high, truly historic levels. They are trying to crash the economy. So the question is, will they be able to kill inflation? Look at this chart. This is the Fed's rapid tightening. The green and red are showing US financial conditions. Obviously, we're in deep red territory right now. The white line is showing inflation. It hasn't worked. That is the very unfortunate reality. So even though they're trying to crash markets, which is absolutely succeeding, we saw the copper chart. Look at that line of inflation. We want to see that come down. That is the most important line. Here's an update, a look at the CPI year-on-year average of utility costs, gasoline, food at home, and electricity. Look at that skyrocketing chart. Again, tightening, not working yet. They're going to have to cause a significant depression for that line to come down. That is very powerful. It's higher than the 1970s. Everyone talks about a return to the 1970s stagflation. Well, right now the CPI is worse. What does that tell you? It tells you the mess we're in. And again, look at the US Empire State Manufacturing, new orders 6 months ahead, crashing down to levels not seen since the tech bust and the global financial crisis. Back then, the Fed was able to stimulate us out of it. Look at the quick rallies back. Look at the tech bust. Quick rally back. Will they be able to stimulate us out of it? You guys tell me. Now, look at how twisted the world is in. Market participants want the economy to crash. They want inflation to die. They want to go into a recession so that the Fed can finally step in and save it. It's very warped. And so we have an indicator, a small indicator that potentially, obviously, home prices are crashing. We saw job openings. We saw copper. It's all happening simultaneously. We'll look at this move in home prices. Canada home prices fell 1.9% in June, biggest decline since 2005. Obviously, 2005 was right before the financial crisis in 2008. We'll look at that dip. Obviously, if you're going to spike interest rates like the Federal Reserve is trying to do, we just talked about the biggest monetary tightening in history, home prices are going to fall. Will that help inflation? Possibly. But look at the Fed fund rate versus inflation. Are they done tightening or not? Because we talked about the US CPI. Look at where it's skyrocketing. The Fed funds rate hasn't even started to make a blip. But we know that the markets are addicted to easy money. And we know that the Fed fund rate in white has just been making lower and lower highs in its entire history. Will it make a higher low than it did in 2020? Possibly, but this chart is out of control. It's saying more pain ahead because the Fed's going to have to raise its rates to match that. Look at the 70s. We had massive CPI, obviously, But then we had also at the same time a massive spiking federal funds rate. Will the federal funds rate have to reach levels like that? That is the huge question. This is the expected prices paid versus CPI. So what you can see here is inflation expectations. So in white is inflation expectation, expected inflations versus the CPI. They do tend to track each other. So is it possible? Is it possible, given everything we've talked about, copper crashing, jobs openings crashing, housing prices starting to crash, Federal Reserve tightening faster than any time in history? Is it possible that this white line is predicting where the CPI is going to go? That is absolutely huge. Will CPI roll over in line with expectations? That is the question. It's a very soft economy, a very soft environment. The Federal Reserve may succeed at stamping out inflation, but if it can't, then it's going to be worse for everyone involved, because unfortunately, the Fed is going to have to tighten and tighten and tighten into a recession, which is very, very dangerous. They're going to have to do that to kill this white line. Now, historically, inflation expectations have matched each other, and that's why the yellow line and the white line, yellow reality, white line expectations have matched. If that white line can come down, then the Federal Reserve will have some wiggle room to save the economy. The setup we have right now, though, could be the mother of all short squeezes. As you can see that chart we showed earlier, the most people short in history may be about to get squeezed because the market is thinking inflation peaked. If inflation peaked, then we can get out of this mess because the Fed can do the same stimulus it's done for the last 25 years. If inflation hasn't peaked, then we aren't anywhere near out of this mess, and it's going to get a lot worse. So just giving you some insights into the charts, what is going on. These are really interesting, crazy times, but they explain everything about the price action of what we've seen. Fed tightening, stuff is crashing. Inflation bad, Fed has to tighten even more, stuff will crash even more. If inflation can die, then the Fed can finally ease and assets can go up. It seems like we're due for a relief rally just based on inflation expectations and the fact that everyone is short, and we're due for a short squeeze. But that's short term. What matters is long term. Can the Fed control inflation? Those are the top 10 macroeconomic charts of the week. This discussion is for informational purposes only. Please consult a certified financial planner for making any decisions about investing. And do your own research before making any decisions. Investments are risky, and you can lose lots of money.